Canada's housing market has been on a bull run for a very long time. I'm not here calling for a collapse of the housing market, but recently the housing market here in Canada has been cooling off and we're starting to see some of the housing prices come down. There are many factors that can contribute to it, but today I want to take a look at one factor that has made an impact, and that's the mortgage rules. So I want to take a look at, in the past decade, how has the mortgage rules changed here in Canada. Before the 2008 financial crisis, they were very lenient in giving out mortgages. There was no down payment required. You can finance 100% of your property value, with the exception of rental properties, as you would need a minimum down payment of 5% only. You could amortize it over 40 years. You could refinance up to 95% of the property value, and you can have a total debt service ratio of 49%. The total debt service ratio is the percentage of your gross income needed to cover all your housing costs and other debts that you may have, such as car payments, line of credit, loans, and so on. So the higher the ratio, the more you could borrow. And on top of that, 80% of your rental income could be counted towards your total debt servicing ratio. In July of 2008, they eliminated the 100% financing, and now you require a 5% minimum down payment. They also reduced the maximum amortization period from 40 years to 35 years. And you also need a minimum credit score of 620 for an insured mortgage. And they lowered the total debt service ratio from 49% to 45%, so you couldn't borrow as much money. In February of 2010, all variable and fixed rate mortgages with a term less than 5 years were required to qualify using the Bank of Canada's rate instead of the contracted rate you receive. They also reduced the maximum amount of an insured refinance from 95% to 90%, so now you can only refinance up to 90% of your property value. The minimum down payment for a rental property also went up to 20% from 5%. And on top of that, they reduced the percentage of your rental income that could be counted towards your total debt servicing ratio from 80% to 50%. So now, any income you get from rent, only 50% of that counts towards your total debt servicing ratio. In 2011, the maximum amortization period for the insured mortgage was reduced from 35 years to 30 years. The maximum amount for the insured refinance was reduced from 90% to 85%. And the home equity line of credit, or HELOCs for short, no longer qualifies for an insured mortgage. In June of 2012, the maximum amount for the insured refinance was again reduced from 85% to 80%, and the maximum amortization period for the insured mortgage was reduced from 30 years to 25 years. They also introduced a new gross debt service limit of 39%, which is like the total debt service ratio, but instead only looks at your housing costs, such as your mortgage payment and property tax. And you also need a minimum credit score of 680. And you can no longer get mortgage insurance on property value over $1 million. In February of 2016, they changed the minimum down payment rules. If the property is valued below $500,000, you can still get away with a 5% down payment, but you will require a 10% down payment for the portion of the mortgage that is above $500,000 and 20% on anything over $1 million. In July of 2016, in British Columbia, they introduced a 15% foreign buyer tax on all residential properties purchased by foreign buyers, so all foreigners would have to pay an extra 15% of the property value. In October of 2016, all insured mortgages with less than 20% down payment would have to qualify with the Bank of Canada's rate. In November of 2016, British Columbia introduced the vacant homes tax, which takes effect in 2017, which states that if you're not a principal resident or if you have not rented out your property for at least 6 months per year, you will be charged 1% of your property value. In January of 2018, all conventional mortgages will need to qualify under the new stress test, which is 2% plus the Bank of Canada's rate, or your contract rate, whichever is higher. In February of 2018, British Columbia increased the foreign buyer tax from 15% to 20%, and they introduced yet another tax, the speculation tax, which is 0.5% of the property value. The tax is exempt if it's a primary residence or if it's rented out for at least 6 months of the year. In March of 2018, British Columbia increased their speculation tax for foreigners from 0.5% to 2%, which would take effect in 2019. Overall, we can see that with each mortgage rule change, it has negatively affected the amount that people could borrow, either by directly reducing the amount you can borrow or by increasing the amount of capital required. This move by the Canadian government does make sense, since they are trying to get people to deleverage since the Canadian household debt levels are very high. But I feel they are a little bit late. But in British Columbia, they are really trying to bring down the housing prices and rent with their new foreign buyer tax, vacancy tax, and speculation tax. but I feel they're introducing too many taxes too soon, because unlike the stock market, which can collapse in a matter of minutes, housing takes a much longer time for it to play out. And by introducing so many taxes so soon without giving them enough time to play out, the effect may be greater than what they wanted when the hand plays out. But I will be watching it closely, as there may be many opportunities in the future, especially for people who are well prepared and can take advantage of the situation. And as always, if you enjoyed the video, please like and share the video. It really helps out the channel. If you haven't subscribed yet, please make sure to smash the subscribe button. And thank you for watching. I'll see you guys in the next video.